5. We also did something to do with the piecemeal or the stage acquisition, where we said that this whereby the parent company has acquired the control or acquires control in the subsidiary through several purchase of shares. Equally, we did a question as far as that is concerned. In our previous class, we looked on how to prepare the group account, whereby we have a disposal of interest. And actually, we say disposal of interest is whereby the parent company has sold some of the shares, or basically all the shares which are held in a subsidiary. So I think we did a question on partial disposal, but because of time, we are going to do another question on that, but not now. During our revision, we're going to do a question on full disposal, because in terms of how we prepare the group accounts, whereby we have a full disposal, I hope you can be able to recall what we said. We account for a subsidiary which has been fully disposed as a discontinued operation. We have to compute its profit or loss before it was disposed, and also the profit or loss arising from the disposal. And actually, we said that one should be recognized as a separate item within the consolidated statement of financial position. So during our revision, automatically we're going to do a question on full disposal. So make sure you remind me on the same during our revision. So today I want us to basically proceed, and we look on this. I think should be the last concept before we look on the group cash flow. I want us to look on what is known as the overseas. In other terms, we refer to this as a foreign subsidiary. A foreign subsidiary. And in this case, the standard which is applicable here is International Accounting Standard number 21, IAS 21, overseas, or basically a foreign subsidiary. So first of all, we need to ask ourselves here, what is an overseas, or basically what is a foreign subsidiary? So this basically a subsidiary which is operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which operates in Kenya has acquired a subsidiary which is either operating in Uganda, in TZ, or maybe like in Rwanda. So that particular subsidiary is operating in a different country from the parent company countries of what? Of operation. So such a subsidiary, we refer to it as an overseas, or basically a foreign what? A subsidiary. So therefore, this is basically a subsidiary company which is operating in a country different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign, or basically overseas what? A subsidiary. Now, in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling. This one using the Rwandan franc. It is obvious that if you are preparing the group accounts, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statement of the parent company is prepared in Kenyan shillings, and the financial statement of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, and maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency. The functional currency. So when talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group accounts using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group accounts is called the presentation currency. On the other hand, we talk about the functional currency. The functional currency, this is basically the currency, the currency of the primary economic environment, the primary economic environment in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you say the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is the foreign subsidiary, must be translated into Kenyan shillings, which is the presentation code currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, items of incomes and expenses, and remember in this case what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them, they are translated, items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in most of this particular question for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the asset and liabilities, the asset and liabilities of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to translation. This arises due to translation of basically three items. One of which is goodwill. Is goodwill on acquisition. Number two is a profit for the year. And number three, the subsidiary company opening net assets. So opening net assets. Opening net assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items, So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items, the goodwill, profit for the year, and the opening net asset of the subsidiary. So let's start with the goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net asset which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency. The fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using the goodwill is computed using the fractional or the local currency of the foreign subsidiary subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. You'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening. O for opening, the opening exchange rate, the exchange rate at the start of the year. So we get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here, that now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. The value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what you refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease, like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year, to the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill, translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns. The local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in in local currency, for example, Rwandan franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value there. And then to this, you add the profit for the year. The profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be affected in the income statement of the subsidiary, like a depreciation other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can revalue assets, like maybe item of PPE or even things like intangible assets, like maybe Brad or something like that. So if that the foreign subsidiary revalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation at the charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate, the average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember these net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes. Will be recognized there as part of the other comprehensive incomes. So basically this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of assets, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I'll say for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of assets and liabilities, those of the foreign subsidiary, will be translated using the crossing exchange rate. Crossing exchange rate. So if you can be able to recall that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022, which is the question number 1. Question number one. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay, okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the securities exchange. Listed in the securities exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we are saying even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there, we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. A group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 3550 million franc. So this company acquired S Limited, and basically this S Limited, remember, we are told is domiciled is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation doc. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is the parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 35.50, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In Part B, also not Part B, rather note 2, we are told at the acquisition date, the carrying value of S Limited net asset was 2,600 million franc, but the fair value was 3,200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3,200 million franc, and the carrying amount of this net asset was 2,600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is a revaluation what? Gain, is a revaluation gain. So, and then you're told the excess in the fair value of the carrying amount was due to unrecognized branch with a remaining useful life of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a brand is a form of a trademark. In other terms, a brand is one. This is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued, or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand would be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset. As an intangible asset within the consolidated statement of financial position is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful life for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation under charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation under charge. We take the revaluation gain for the value at which the asset was revalued at. We divide that with the remaining useful life or economic life. And I think we are told the remaining economic or useful life in note number 2 were 5 years. 5 years, we divide that with 5, and then we should multiply that with the proportion of time. the proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is in foreign subsidiary. This is in foreign what? Subsidiary. So this one, this amortization, number one, this one is basically an expense. Is an expense within the consolidated income statement. And number two, this one will be deducted from this. So this one will be deducted from intangible assets. So the value for intangible asset would be 600 minus this one, which is basically 120. So I think we are done with that. Let's move to the other point. So let's move to the other point. So in point number 3, we are told the non-controlling interest in 𝐻 Limited as at the date of acquisition was fair valued at 1450 million franc using the fair value model or the fair value method. So it basically means that in computation of goodwill, we are going to use the full goodwill method. That's why we are given the NCI at fair value. So, and then number 4, we are told as at 31st of December 2021, that is at the end of the year, it was determined that the goodwill arising on acquisition of S was impaired by 10%. That is the impairment loss. Okay. So number 5, we are given the exchange rate. We are told the foreign exchange rate are relevant. So what you must be in a position to do is to interpret those exchange rates. For example, we are given the exchange rate on how many days? We are given 3 exchange rates. On first, at the start of the year, which is the opening, we are also given the closing exchange rate, and then you are given the average. You're given what? The average. So how do we interpret that? For example, the exchange rate here at the start of the year. So it is given up there. You can see franc to 1 Kenyan shilling. Franc to 1 Kenyan shillings, and the opening is 5. So this means that the opening exchange rate is 5 franc. 5 franc. This one is equal to 1 Kenyan shillings. Sasa, is that basically the interpretation of that? That 5 franc is equal to 1 what? Kenyan shillings. Sasa, yes. So that's basically what we have. And I think now having that information, we can just go straight to answering our question. Let's just go direct to answering our question. But I think before we do that, we start, basically we're going to start with Roman 1. I think the first thing we need to do is let's compute the goodwill arising from acquisition. And remember, you said we compute the goodwill arising from acquisition of this subsidiary using the foreign currency. The foreign currency of 𝐻 Limited is franc. We compute that goodwill using franc, and then we are going to translate it into Kenyan shilling. In the process of doing that, we are going to determine the exchange gain or loss as required in Roman 1. So let's do that. And basically that will be part of the workings. And then we will be able to use that goodwill, to compute the exchange difference. So remember, in this case, the method we are going to use is the full goodwill method. The full goodwill method. So at the full goodwill method, here we just need to let's just have one column. We are computing this in franc. In franc, the foreign currency, the franc, and the figures are given in million of shillings. So goodwill using the full goodwill method, or we compute the goodwill using the full goodwill method by, number 1, taking the purchase consideration which was paid by the parent company. To this, we add the NCI at fair value. At fair value. Remember, we are computing this using the foreign currency, the local currency, which is franc. So this purchase consideration, which was paid by the parent company, that one is within note number 1. Note number one, which is given in franc, and that is 3550. So we also have this one, NCI at fair value, in note number 3. Note number 3. So the NCI in 𝐻 Limited at the date of acquisition was valued at 1450 million franc. So we add these two values. What do we get? What are we going to get here? Is it 6,000? 6,000 franc? What are we going to get there? Purchase consideration paid by the parent note 1, that 550 plus the NCI at fair value in note number 3, 1450. That will give us 5,000. That will give us 5,000. 5,000. So then to this, we proceed and we less the fair value of net assets acquired. So in our case, we know at the date the subsidiary company was acquired, the fair value of its net asset, as per the information we have in note number 2, the fair value of its net asset is already given. This one, it was that 200 million franc. That is still in franc. Now, take into account we are using the full goodwill method. We will take 100% of this. We are using a full goodwill method. We take 100% of that. So the goodwill arising from acquisition, the goodwill arising from acquisition is how much? Goodwill arising from acquisition is how much? Is the goodwill arising from acquisition is 1,800 million. 1,800 million. It's also important for you to note that this is still in, this is in foreign currency. This one is in franc. Now, having that, I think we can just go straight to part A of that question, part A, and basically we are required to compute the exchange difference, the exchange what? The exchange difference, which is basically a gain or a loss, on translation of two items, net asset and goodwill. So we're going to start by computing the exchange difference on translation of goodwill. On translation of goodwill. Translation of goodwill. Translation of goodwill. Translation of goodwill. So this one is very, very simple. Very, very simple. Provided you can be able to remember the format which I've given you for computing this. If you can be able to remember that format, this one is quite simple. So in this case, we need to have various columns here. The first column here will be for the foreign, the local currency of the foreign subsidiary, which is franc. We have the exchange rate, and then we are translating that to Kenyan shillings. And our figures are in million of shillings. Are in million of shillings like that. So what we start with here, we start with the goodwill on the date of acquisition. The goodwill on the date of acquisition. So the goodwill on the date of acquisition is this one. That is 1,800. 1,800. So we translate this into Kenyan shillings using which exchange rate? Which exchange rate do we use here? Remember, this is a goodwill on the date of acquisition, 1st January 2021. Is that the case? So we translate this using the opening exchange rate. The opening exchange rate as per note number 5 is 5. And basically that is 5 franc, which is equal to 1 Kenyan shillings. So how do we translate this into Kenyan shillings? Remember this is franc. This is 1,800 million, sorry, 1,800 million franc. We want to translate that into Kenyan shillings like that. So basically we need to cross multiply, then we divide. So we take 18 times 1 into divided by 5. In other terms, what is important for you to note here, when translating, in translating franc into Kenyan shillings, you'll take the figure which is in franc, you divide that with the exchange rate. Like in this case, 1,800 is in franc. To translate that into Kenyan shillings, you divide that with the exchange rate. If you know that now, it becomes much simpler. Yes, because you'll be taking all the figures in franc to divide to translate them into Kenyan shillings. You divide that with the respective exchange rate. So we will divide that with 500. So we take this divided by 5, not 500, sorry, by 5. That will give us what? That will give us what? We try to hurry up. So that one will give us 360. That one will give us 360. And then out to this, we have said we need to less the impairment loss. The impairment loss. So the impairment loss, we are given that information in note number 4. Note 4, we are told as at 31st of December 2021, it was determined that the goodwill on acquisition of S was 10% impaired. So this goodwill was 10% impaired. 10% of this is 180. 180. So first of all, we need, this is an item of expense. Being an item of expense, we will translate that into Kenyan shillings using the average exchange rate. The average exchange rate, as per note number 5, is what? Is 4. Is 4. Is 4. So we take this divided by 4. What do we get? 180 divided by 4. That will give us what? That will give us 45. 45. Then what we do, we take, remember this one should reduce the value for goodwill. So what you do, you leave 2 lines there. And then we will have the value for goodwill at the end of the year. That is on 31st of December 2021. So this minus that basically that will give us what? 1800 minus 180. That one will give us 1620. So that's the value for goodwill at the end of the year in foreign currency, in functional currency. Sasa? Yes. Now, before we proceed to determine the exchange difference, which is a gain or a loss, first of all, get the difference between these two values. Write that value here. Write that value there. Oh, sorry. So this one should be 6. The average is 6, not 4. The average is 6. Yes, thank you for that. The average is 6, not 4. The average is 6. So this one will be 30. That one will be 30. Is that the case? Yes, 180 divided by 6 is 30. Is 30. The average is 6. Yes. So we get the difference between this, which will give us 330. 330 equally, ensure you have a line here. Then what we do, we translate this goodwill at the end of the year into Kenyan shillings using the crossing exchange rate. The crossing exchange rate is what? Is 4. So we take this divided by 4, and that now will give us the value for goodwill at the end of the year in Kenyan shillings divided by 4. That will give us what? 405. Now then we compare these two values here. We compare those two values there. We determine we have an increase or a decrease from 330 to 405. What is that? That one is automatically an increase. Is automatically an increase. An increase of what? An increase of 75. So being an increase, we refer to that as the exchange gain. As the exchange what? Gain. And basically I'll say that this one within our consolidated statement of profit or loss is part of other comprehensive income. Is part of other comprehensive income. So basically that's how we compute the translation or the exchange difference, which is the exchange gain or loss arising from translation of goodwill. Arising from translation of goodwill. So then still in Roman 1, we need to compute the exchange difference, which is gain or loss, which arises on translation of net assets. Translation of net worth asset. Translation of net assets. Translation of net assets. So we need to have the same format here. The local currency or the functional currency of the foreign subsidiary, the rate, and the presentation currency, which is Kenyan shillings. So here we start with the opening net assets. So the opening net assets is what we have here. So we know that at the date the subsidiary was acquired, it revalued its net assets, and the net asset of the foreign subsidiary had a value of what? 32. So that is the opening net assets. The opening net asset of the foreign subsidiary. So we need to translate that into Kenyan shillings using the opening exchange rate. The opening exchange rate is 5. This one. The opening exchange rate. The opening exchange rate. That will give us what? 32 divided by 5. So which will give us what? 6. Are you getting 640? Are you getting 640? Yes, 640. Then to this we have said we add the adjusted profit for the year. The profit for the year of the foreign subsidiary. And basically that one should be the adjusted one. the adjusted one. So let's go to the income statement of S Limited, which is a foreign subsidiary. From the income statement of S, how much was its profit for the year? Its profit for the year is 1,500. Is 1,500. 1,500. I hope you can be able to see that. From the income statement of S, its profit for the year, is that 1,500? 1,500? Yes. Now, I've said you need to check whether this foreign subsidiary, that is S, whether it had something like depreciation, other charge, depreciation overcharge, maybe something like amortization, which was not yet accounted for. So in our case, what we have is this amortization. Remember, S Limited didn't account for this revaluation of asset. It never accounted for this amount. It equally never accounted for this what? Amortization. So if this amortization was accounted for, automatically that one was supposed to be deducted in arriving at this what? Profit. So we deduct that amortization from that profit for the year. That will give us what? That will give us 1,380. Is that the case? 1,380. 1,380. Are you getting 1,380? 1,380. 1,380. I'm not getting answers today. I'm not getting answers. I'm not getting answers. Karaja, I need to get answers. Peter, I need to get the answers. Once you get the answer, type it in the chat box. Type the answer in the chat box. Type the answer in the chat box. Yes. Now, in this case, we have said that this being the profit for the year, we translate it into presentation currency using the average exchange rate. The average exchange rate in our case is what? A6. A6. So we take 1,380. 1,380 divided by 6. 1,380 divided by 6. Divided by 6. That will give us what? That will give us to 30. So then what we need to do, make sure you leave 2 lines here. And then we have the net asset, the crossing net asset. This question, the crossing net assets. The crossing net asset will be this plus this, which will give us 4580. 4580. And actually, this one should always reconcile. This one should always reconcile with the net asset of the subsidiary at the end of the year. Remember how we compute the net asset of a subsidiary. We said you can either take asset minus liabilities or equity. We said in group accounts, we compute the net asset as the share position. The first thing we must have here is the title of what we are preparing. What are we preparing? We are preparing the statement of financial position of 𝐉𝐎𝐈𝐍. So we have the title, the name of the sole trader, and that is 𝐉𝐎𝐈𝐍. So this is what? The statement of financial position. The statement of financial position as at 30th of September, 30th of September 2024. 30th of September 2024. Now, remember, we say that this statement of financial position, this one is prepared basically to ascertain the financial position of a sole proprietorship business at the end of the year. How do we prepare this one? We prepare this based on the accounting equation. The accounting equation we states that if you take assets are equal to capital plus what? Liability. So therefore, in preparing this, we start by recording assets. And then you also have to record that assets are classified into 2, the non-current assets and the current asset. I was able to explain what you mean by the non-current asset. We say that these are the assets which are acquired by the business to help the business in terms of generating revenue or in terms of generating what? Income. If, for example, you have a business, you may decide to buy a motor vehicle. That motor vehicle is to help you in your business to make revenue. So these are the assets acquired to help a business to generate revenue. And number 2, we said these assets are expected to be used in a business for a period exceeding 1 year. Now, current assets are the assets which are related to the trading activities of the business, e.g. inventory, e.g. receivables, e.g. cash, e.g. bank balance. And these assets are expected to last for a period less than 1 year. So we will start by recording assets, which we classify into 2, non-current and current. And then from there, we record capital And then finally, we record liabilities. Liabilities equally are classified into two, non-current liabilities and current liabilities. So we start by recording assets here. We start by recording what? Assets. And basically, we always start by recording the non-current assets. The non-current asset. The non-current assets. So in this case, we just need to have a single column here. And I hope you can also be able to record the figures which were given in the trial balance. Yes. So we just need to write that our figures will be in thousands of shillings. So what we need to do is we go back to the trial balance. We check the non-current asset. Non-current asset, I've said, is an asset which is acquired by the business to help the business in terms of generating revenue. These include assets such as land, buildings, motor vehicle, furniture and fittings, and so on and so on. And this is also something you need to recall from what we covered in the topic of the ledger account. In the topic of the ledger account, I was able to explain what are the assets and so on. So therefore, from the trial balance, I think we have a number of assets. Can we go down there from where we have landed buildings? Can you see landed buildings? Yes. So I hope you can see landed buildings. Land and buildings. Land and buildings. So the value for landed buildings there is what? Is 2,550,000. Now remember the format which I gave you. We say that when recording the asset here, that is the non-current asset, we record them here at the net book value. At the net book what? Value. So how do we compute the net book value of an asset at the end of the year, which is basically recorded here? The net book value of an asset at the end of the year is equal to the cost minus the accumulated depreciation at the start of the year. And the accumulated depreciation of the asset at the start of the year are the accumulated depreciations which we have in the trial balance. If you check on the trial balance which are given here, the last items down there, you can see we have accumulated depreciations. Those are accumulated depreciations at the start of the year, which are part of the trial balance. So other than deducting this accumulated depreciation at the start, we also list the depreciation for the current year. Depreciation for the current year. And basically this is the depreciation which is in the statement of a profit or loss. So that depreciation which we accounted for as an expense in the statement of profit or loss is the depreciation for the current year. So therefore, it's very, very important to note this. How do we compute net book value of the asset at the end? Take the cost minus accumulated depreciation at the start, which is in the trial balance, minus the depreciation for the current year, which is in the income statement or the statement of profit or loss. Now, if you check the depreciations which are in the trial balance down there, you'll be able to see those are depreciation for plant and machinery, motor vehicle, furniture, and fittings. So meaning that we don't have any depreciation for landed buildings. So basically, there is something I mentioned in our previous class. There are those assets which do not lose value. Like if you have land do not lose value. In fact, land appreciates. The value of land keep on increasing. So that's why you can see there is no depreciation for this. But if there was depreciation, then we would have taken the cost, which is 2,550,000, minus the accumulated depreciation at the start, basically, which is 0, minus the depreciation for the current year, which is equally what? 0. And then in that case, we get the net book value at the end of the year. In this case, the net book value of landed buildings remains the same. Remains the same. I want us to move to the other asset, which is below landed buildings, and that is plant and machinery. Plant and machinery. So we will use this approach. So we take the cost which is in the trial balance, 1,600,000. And then I want us to use this formula. We must be together here so that you understand this. So this is the cost. Whatever you have here is the cost. I want us to just the accumulated depreciation at the start, which is in the trial balance. So who can tell us how much is the accumulated depreciation for plant and machinery in the trial balance? How much is that figure? Down there in the trial balance. The accumulated depreciation at the start for plant and machinery. Yes, it is an amount of 447. Please, once you get the answer, type it in the chat box. Ndio mwalimu ajue kama tuko pamoja. Once you get the answer, type it in the chat box. Sasa, yes, so that I know whether we are together. So that I know whether we are together. Are we moving together or we are lost? The mwalimu can only be able to know that this is where we are communicating in the chat box. That's where we communicate. Sasa, yes, once you get the answer, type it there. That's the only way I can be able to know whether we are together. Yes, so the accumulated depreciation at the start is 447, 010. And then to this we less the depreciation for the current year. This is the depreciation which we computed as per note number 6, and also the depreciation which we recognized as an expense in the income statement. So who can give me that depreciation for this one? I think it was 400,000. Was it 400,000? The depreciation from the income statement for the current year? Yes or no? Is it 400,000? Is it 400,000? I'm only getting answers from Evans. The depreciation for the current year. Ukienda kwa income statement, you'll be able to see we have depreciation which is recognized as an expense. Is it 400,000? Yes. So that's basically how we compute the net book value. So before we do this, I want us to do the same for the other assets, because we also have other non-current assets, including motor vehicles. Including motor vehicles, we will do the same. We take the cost, which is 843,000, minus the accumulated depreciation at the start of the year, which is in the trial balance. In the trial balance is a figure of 168,600. And then can you give me the depreciation for the current year? The depreciation for the current year from the income statement. The depreciation for the current year in the income statement. Give me that figure. Give me that figure in the chat box down there. You just need to go back to the income statement and you check how much is the depreciation for the current year. How much is the depreciation for the current year for motor vehicles? The one which we computed, it was 168,600. So do we have any other assets? I can't see any other. I can't see any other asset. I can't see any other asset, any other non-current asset. So I think we have only those three. So what we need to do here is we compute now the net book value. So let's start with the plant and machinery. I will take 1 million, 1.6 million, 1.6 million minus 447, 010 minus 400,000, and I'm getting 752, 990. 990. 900. Oh, there is one which has skipped. Okay, I've not seen that one. Furniture and fittings. Yes, furniture and fittings, I've seen it. Yes, thank you for that. Furniture and fittings. And fittings, we do the same. We take the cost, which is the 245,000. 245,000. We less the accumulated depreciation at the start, which is in the trial balance, 14 to 40. How much was the depreciation for the current year? The depreciation for the current year from the income statement. The depreciation for the current year from the income statement in Esther, Benson, Paul, 625. That is 625. Okay, so having that now, can we compute these net book values? Let's compute these net book values. We compute these net book values. So confirm whether you have gotten that one for plant and machinery. Have you gotten 752,990? Yes. So we move now to the other one, motor vehicle. We have 843 minus 168.6. These two are the same. The accumulated depreciation at the start and also for the year. They are the same. These two figures here. Are they the same? For motor vehicle, the accumulated depreciation at the start and for the year. They are, right? Okay, sawa. Okay, so let's get the net book value at the end. So I'm getting 505,800. 505, 800. What about furniture and fittings? 245 minus 14.24 minus 30.625. And that will give us 200. 135. So therefore, that's basically how we compute the net book value of the assets, of the non-current assets at the end of the year. This formula is very, very important. You need to remember that formula moving forward. So if formula write it somewhere, right? This formula somewhere is very, very important. This is now what we will be using moving forward. Okay. So having that, then we need to proceed and we record the current assets. The current assets. Now, for the current asset, we said are assets related to the trading activities of the business. These include assets such as inventory, cash at bank, prepaid expenses, and so on. So which asset do we have? And recall we said, once you go to the trial balance, and you're looking for assets, where do you look for this particular asset in the trial balance? Which column? Evans. Where do you check for this asset in the trial balance? Esther, Rin, Hussein, where do you check for the asset in the trial balance? Yes, we said you check them in the debit column. In the debit what? Column. If you can be able to remember that, that will make your work very easy. Will make your work very easy. Will make your work very easy. Very easy. Very easy. Sasa? Yes. So let's check the items on the debit column. Up there we have purchases which we dealt with in the income statement. Down there you can see return inwards, discount allowed, downstairs salaries and wages, rates, insurance, general expenses. All those are expenses, but we have trade receivables. Trade receivables. This is the amount of money expected from the debtors. So the trade receivables amount is the 552,000. But this amount, the reason why I'm writing it here is because it will have some adjustments. If you check on the workings we did, we said that there are two items which are to be adjusted to this. If you can be able to recall those workings which we did. The first adjustment to be made to this is the working which we did in relation to note number 4. In relation to note number 4, can we go to note number 4, additional information number 4? We are told the trade receivables include an irrecoverable amount of 84. So we said that irrecoverable amount should be deducted from this because out of this, the company expects that it will not be able to recover an amount of 8,400. We need to less it here. Then also in note number 5, we computed allowance for doubtful debt, which we said we recognize as an expense, and number 2, we also deducted here. So who can give me that allowance for doubtful debt? The allowance for doubtful debt which we computed as per note number 5. As per note number 5, how much was that? It was 27,180. So that's basically how we get the net amount of receivables. The amount which was written off and the allowance. So the allowance we said is an amount which is set aside to cater for the losses to be incurred once the customer fails to pay. It is recognized as an expense and also it is deducted from receivables. So this will give us a net amount of 516 for 20, 516 for 20. So confirm whether that is what you're getting. Is that what you're getting? Please confirm. I want us to finish this question and we do another one. We must do another one because I want us to wind up with this topic today. Is that what you're getting, Lynn? Is that what you're getting, Benson? Esther, is that what you're getting, Hussein? Is that what you're getting? Eunice? Paul? Yes. So then, what else do we have? Which other current asset do we have? Remember, we are taking the items appearing on the debit column. So below the receivables down there, I'm not interested with the items appearing on the last column of the trial balance. Those items cannot never be assets. Down there, you can see inventory. Inventory, which we recorded here is the closing. not the opening, because that is the opening. Below that, we have plant, motor vehicle, drawings, furniture. None of those is a current asset, but we have cash. Cash, that is a current asset, and that is an amount of 300. Then I can't see any other. Can we go to the additional information now? In the additional information number 1, we have the closing inventory, the inventory at the end of the year. The closing inventory here is recognized as a current asset. So the closing inventory at the end of the year had a value of 600. And then below that, we have some rates which were paid in advance. So we said any expense which is paid in advance is a current asset. Any expense paid in advance. So we have prepaid rates. Prepaid rates in that case is an amount of how much? 10,500. 10,500. And then from there we have note 3. Note 3 we have outstanding electricity. Outstanding electricity basically is an expense which has not been paid. An expense not yet paid is a current liability. We have dealt with note number 4 and note number 5 because note number 4, note number 5 are affecting receivables. Note number 6 is about depreciation. We have dealt with that. And then note number 7, we are told included in salaries and wages is an amount of 93 paid domestic workers. We said this is part of the drawings. Finally, note number 8 is about outstanding wages. Outstanding wages is basically a current what? Is a current liability. So basically in our case, we don't have any other current asset. So what we need to do is we get the total assets. So the total assets, we add all this. Let's add all this. We have 2550 plus 752, 990 plus 505, 800 plus 200, 135 plus 516, 420 plus 60, 300 plus 222, 600 plus 10.5. So I'm getting a figure of 4,818,745. 745. Is that what you're getting? Is that what you're getting, Paul? Yes, that is confirmed by Evans. That is confirmed. Yes. Now we said after getting this, we double underline. So double underline means what? That is the end of the first part. Because we are preparing this based on this equation, assets are equal to capital plus liability. So we are done with asset. So then from there, that's why we are double underlining. That is the end of the first part. We proceed to record what? Capital. So we record capital here. And capital, that one, I think, is the first item within the trial balance. That is the first item within the trial balance, which is 4,047,48. And then 430. And then to this, remember, during the current year, we had a loss. Can you remember the loss? Yes. So in case you have a profit you add it to this. But in case you have a loss you less it. So the net loss for the year. Can you give me that net loss, which we got in our income statement? In this case, you may decide to have 2 columns here or 1. You can't be penalized because of that. Sasa? Yes. You can use 2 columns or just 1. You can't be penalized because of that. Sasa? Yes. You can't be penalized because of that. You may decide there are different approaches. Kuna mwalimu atafunza hizi current asset aziweke hapa, akuwe na column mbili. The current asset to be recorded here. Once you get the total, you take it. But in an exam, you can't be penalized because of that. What is marked in an exam are these final figures. The person who is marking will not be interested whether you have 2 columns or 1 column. Sasa? Yes. So you can't be penalized because of either using 1 or 2 columns. Sasa? Yes. So I'm given the loss here, which was 171,155. And remember, loss should be deducted. We said what is the rule? Any figure which is to be deducted, record it here inside the bracket. Sasa? Yes. Then to this, we also left drawings. Now, drawings, we have 2. We have 2 drawings. So first of all, we have some drawings within the trial balance. I don't know whether you can see them. The drawings in the trial balance, just above the furniture and fittings. The drawings of how much? The drawings of 312, 300. Can you see those drawings within the trial balance? Yes. Can you remember the other drawings? Who can be able to remember? We also have other drawings. I don't know whether you can be able to remember we have other drawings. Who can be able to remember those other drawings? Who can be able to remember the item to be treated as drawings? The item to be treated as drawings. The item to be treated as drawings is what? Is what we have in note number 7. What we have in note number 7. These salaries and wages which were paid to the domestic worker, to the domestic worker. That is basically like taking money from your business. You pay your personal expenses. That is a drawing. That is what? Drawings. It reduces the money you invested in your business. So that will give us what? That will give us the total drawings of how much? Total drawings of how much? Total drawings, 4,500. Yes. So then here we get the net capital. We get the net capital, or basically the capital at the end of the year. We work out that. We take the capital at the start, we less those 2 figures. 47, 48 minus 171, 155 minus 405, 300. I'm getting 4171, 975. Confirm whether that is what you're getting. Confirm. Is that what you're getting? Is that what you're getting? That's what you're getting? This minus that. Yes. So after getting capital, we proceed and record liabilities. Liabilities, we classify them into 2. Non-current liabilities and current liabilities. So here we always start by recording non-current liabilities. Non-current liabilities, we say that these are liabilities which are payable for a period exceeding 1 year. Now, we said in a sole proprietorship business, this can only take the form of a bank loan. The sole trader, the only non-current liability a sole trader may be having is a bank loan. So if you check on the information which you're given, and also you have to recall, we said when checking for the liabilities, you check the items appearing on the credit side of the trial balance. That's why we have liabilities. So on the credit side, no, Easter we have to finish. Let's finish and then I'll give you a short prayers break. Let's finish this. It should take us 5 minutes. We finish and then I give you a short prayers break. Yes, let's proceed so that we finish. I give you a short prayers break. Okay, so on the credit side, what do we have? Up there, I can see we have capital, we have sales. Are those expenses? No. And in fact, if you check on that trial balance, there is nowhere we are given a bank loan because as I'm saying, the only non-current liability a sole trader can have is a bank loan. So there is nowhere we have a bank loan here. And then finally, we record the current liabilities. Current liabilities, these are liabilities payable within a period of 1 year. We have a number of them. Equally, when checking for liabilities, check the items appearing on the credit side of the trial balance. So up there, I can see we have capital And I'm checking the items appearing in the last column of the trial balance. I can see we have what? We have a capital. And then down there, you can see we have sales, we have the return outwards. Down there, you can see we have discount. Down there, you can see we have payables, trade payables. Trade payables is the first current liability, trade payables. How much is that? That is an amount of 483,600. And then below that, we have equally a bank overdraft. A bank overdraft is still a current liability, and that is 120,600. So you can see all liabilities, they appear on the credit side of the trial balance. Then down there, we have accumulated depreciations. Accumulated depreciations are not automatically liabilities. Then can we go to the additional information so that we wind up? In the additional information, number 1, we have dealt with that. Number 2, we have dealt with that. But if you go to note number 3, we have outstanding electricity. In this case, we said any expense not yet paid at the end of the year is a current liability. Any expense not yet paid at the end of the year is a current liability. And that is an amount of how much? That is an amount of 5370. So then below that, we have note number 4 and 5. We have dealt with that because those two notes were affecting the receivables. Note number 6 is about depreciation. Note number 7 is about drawings. And then finally, note number 8, we equally have outstanding salaries and wages. These are still current liabilities. Outstanding salaries and wages, which amount to how much? Which amount to 37,200. And basically, in our case, we are done. We are done. So what we need to do here is we get the total capital and liabilities. Total capital and liabilities. Total capital and liabilities, how do we get that? We take capital, this one, and then we add all these liabilities. We add all those liabilities. We should get a figure which is same to this. Confirm that. 41,71,975 plus 483,600 plus 120,600 plus 5370 plus 37,200. That should give us a figure which is similar to this: 48,18,745. 745. Is that what you're getting? Is that what you're getting? Yes. So therefore, whatever you get here, basically should be the same with the total asset, because we are preparing this based on the accounting equation. Asset, this one must be equal to capital plus liabilities. Sasa, yes. So that basically what is required. I want us, we have a short break, and then as we come back, I want us to look on another question. This is a question I want you to have as we come back. We have a question here which was examined, I think, in the sitting of May 2017. May 2017, question number 4. Question number 4. Can you take that question just as I confirm? Yes, so that is a question. That is a question I want you to have as we come back. So we take that short break. We come back at exactly 7 so that we do this question. So let's take that short break. Yes, so what are we told? We are told the following trial balance was extracted from the books of Joyce Merrill as at 30th of April 2017. So we have the inventory as at 1st May 2016, purchases, return outwards, cash in hand, bank balance, building at cost, salary expenses, stationery, legal fees. We have allowance for doubtful debt, trade receivables and trade payable salaries, capital, selling and distribution cost, discount allowed and discount received, sales, equipment at cost, rates and insurance, return inwards, accumulated depreciation on 1st of May 2016 for building and for equipment. So then we have additional information, number 1 all the way to note number 6. And then what are we required to do? We are required to prepare the income statement for the year which ended 30th of April 2017. And part B, we are required to prepare the statement of financial position of this sole trader. So what I want us to do, I want us first of all, we go through the additional information which are given from note number 1 all the way to note number 6. We do some few workings, and then from there we prepare what is required in part A and also in part B. So let's go direct to additional information number 1. Additional information number 1. Remember, this is a question for May 2017, and this was the question number 4. So we start with some workings as per the additional information. So what are we told in the additional information number 1? In the additional information number 1, you're told allowance for doubtful debts is to be increased to 5 million. Is to be increased to 5 million. So basically what we say is that during the current financial year, as far as the allowance or the provision for doubtful debts is concerned, we consider, or basically what we account for in the income statement is the increase or decrease. Is the increase or decrease. So what we need to do, we need to go back to the trial balance and you tell me how much is the provision for doubtful debt at the start of the year, because that is what that provision for doubtful debt at the start of the year is given. So the allowance for doubtful debts, allowance for doubtful debts. So we have the allowance for doubtful debts at the start of the year. At the start of the year, this is the allowance for doubtful debts in the trial balance. And then we also have the allowance at the end of the year. So we compare the two, and basically we determine the increase or the decrease. So can we go back to let's go back to the trial balance. And in the trial balance, where do we have the allowance for doubtful debts? The allowance for doubtful debts in the trial balance is, where do we have that? That is somewhere in the middle of the trial balance. I don't know whether you can see it. Below the legal fees. So the allowance for doubtful debt in the trial balance, can you see that amount? Evans, Peter, Esther, Rin, can you see that amount? Yes, it is an amount of 35. That is the allowance for doubtful debt at the start. Then, if you go back to the trial balance up there, can you see what you're told in the trial balance up there? You can see the trial balance. We are given our figures up there in thousands of shillings. What does this mean? It basically means that all of the figures you're given in the trial balance, the last 3 zeros have been omitted. For example, in this case, the actual figure for this should be 3.5 million. Should be 3.5 what? Billion. So for you to be consistent, what you need to do is that anytime you are taking a figure from the additional information, also omit the last 3 zeros for you to be consistent. Are we together? Yes. So now, once we go to note number 1, we are told the allowance for doubtful debt at the end of the year will be increased to 5 million. But because our figures are in thousands of shillings, for us to be consistent, we equally omit the last 3 zeros. So then what we do, we compare these two allowances, the allowance at the start and the allowance at the end. We determine, do we have an increase or a decrease? But in our case, we are told it is an increase. So we have an increase in allowance for doubtful debts over 1,500. So this allowance for doubtful debts, remember we said, or this increase in allowance for doubtful debts, we said is an expense. So any increase in allowance for doubtful debts is what? Is an expense. But if it was a decrease, we said it is recognized as an income. And then when preparing our statement of financial position, this allowance for doubtful debts, this one, 5,000, this one is what we left from the receivables. From receivables, we left this one, allowance for doubtful debts at the end of the year, not at the start, not the allowance at the start, not the increase. So we are done with that. Let's move to note number 2 because of time. If you're off somewhere, you just let me know. So on note number 2, we are told rates as at 30th Okay, rate due as at 30th of April 2017 amounted to 500,000. Rates and expenses. Rate due, these are expenses, or these are rates which were not yet paid. So in that note, we are told there were rate due. They were rate due. In other terms, these are rates which were outstanding, the rates which are not being paid. So those rates had a value of 500,000. I've said we need to be consistent by omitting in all the figures we are taking from the additional information, we omit the last 3 zeros. So these rates which were due, number one, we will add this to the rates which had already been paid. We add this now to the rate in the trial balance, and number two, these rates not yet paid. This one is a current liability. This one is a current what? Liability. This one is a current liability. Evans is saying the internet is not stable. I hope it is your internet, Evans. I hope Mwalimu's video is clear for the other. For Tina Paul, is Mwalimu's video clear? Paul, Mpate, Nicole, can you get Mwalimu's video clearly? Okay. Yes, Evans, maybe you can try to follow up, even if your network is not working. You can try to just follow up. Okay. So therefore, this rate not yet paid will be added to the rate already paid in the trial balance. And number two, they'll be treated as a current liability. Number three, inventory on that year, April 2017, was valued at 52 million. This crossing inventory, this one we will use it in computation of the cost of sales. It is also a current asset. No working care. Number four, we are told drawings amounting to 10 million have been debited to the capital account. Drawings amounting to 10 million have been debited to the capital account. So basically, to debit drawings, or if you're told drawings have been debited in the capital account, it basically means that these drawings of 10 million have already been deducted from capital, because remember we said a capital has a credit balance. Capital has a credit what? Has a credit balance. So if you're told an item was debited in this account, it basically means that reduced the capital. The capital. So it basically means that during the current year, this sole trader had drawings of 10 million, but those drawings have already been accounted for. Do we need to account for them again if they have already been deducted from the capital? No, we don't need to deduct them again from the capital. Alternatively, you can do this. You take the figure of the capital in the trial balance, and I think it's a figure of 116,800. 116,800. You add this back then, this 10 million, but there is no need of doing that. Let's just ignore that, because these drawings of 10 million, they have already been deducted from the capital. So there is no way we are going to consider that transaction of 10 million. So the drawings have already been accounted for. They have already been deducted from the capital. So that note, we will not use it anywhere, because essentially that's how we treat a capital. That's how we treat drawings. We let it from capital. We move to note number 5, and I want us to compute the depreciation. The depreciation to be charged is to be charged on cost on the foreign rate. So let's compute those depreciations. And we are going to start by computing the depreciation on buildings. In this case, we are told this will be 5%. And I hope you can see in paragraph 1, we are told depreciation will be computed based on costs. What is the cost of buildings in the trial balance? The cost of buildings. Where do we have them? We have somewhere in the middle of the trial balance. In the middle of the trial balance, the buildings have a cost of 50 million. I hope you can see that. 50,000 in the middle of the trial balance somewhere. Can you see that? Esther, Rin, Peter, can you see that somewhere? Hussein, Nicole, Mpate, can you see that somewhere? Yes. So then we will be able to compute that. We also compute the depreciation on equipment. Which is 10% of the cost. So the cost of equipment, where do we have equipment? We have them downstairs somewhere. basically 5,000. So 10% of this is 500. 5% of this would be 25, 2,500, 2,500. That should be the depreciation for the current year. Are you getting those values? 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 Eunice, Esther, Rin, you're getting those values? Those values, is that what you're getting? Is that what you're getting, Juma? Yes. So then finally, note number, this remember was working number 3, working number 4 in note number 6. In note number 6, we are told insurance amounting to 200,000 relate to the year which ended 30th of April 2018. So the current year, if you check on the requirement, ended 30th of April 2017. So we are told insurance of 200,000 relate to the following year. So which name will be given to those insurance? To those insurance expenses which relate to the following financial year? To the following financial year, but automatically were paid during the current year. Which name do we give to those insurance expenses or to that insurance expense? Paid during the current year, but it is for the next financial year. Yes, that one is known as a prepaid expense. Is a prepaid expense. So specifically prepaid insurance. Specifically prepaid what? Insurance, prepaid insurance. Prepaid insurance of 200,000. Over 200,000. So this 200,000, the prepaid insurance, number 1, this one will be treated as a current asset in our statement of financial position. And number 2, we less this from insurance expense. We also less this from the insurance what? Expense. We less that from the insurance expense. So that basically are the adjustment. Having that, I want us to quickly move now and basically prepare what is required. Starting with the part A of the question. In part A, we are required to prepare the income statement. So we have the name, the title. The title, we start with the name of the sole trader, Joyce Mero. This is the income statement. The income statement, basically, which is for the year, which ended 30th of April 2017. 30th of April 2017. 2017. So let's prepare this together. We prepare this together. So here we said we need to have 2 columns. We need to have 2 columns. And in this case up there, we will be able to indicate that our figures are in thousands of shillings. In thousands of shillings means that those figures which you're going to write here, the last 3 zeros have been omitted. The last 3 zeros have been omitted. So what do we start with here? We start with the sales. We start with the sales. When we have sales, remember you said sales is an income. We check this on the credit side of the trial balance. So the sales, I can be able to see that where do we have the sales? The sales, it should be on the credit side. The sales, yes, I can see that somewhere above the equipment, below the discount around a discount received, which is an amount of 229,950. So to this we said we less the return inwards, or basically the sales return, the return inwards or the sales return. So the return inwards, do we have return inwards in our question here? Yes, I think there is somewhere. So, or was it return outwards? Do we have return Yes, we have returned inwards from the bottom of the trial balance, above the accumulated depreciation, we have returned inwards of 1550. 1550, we get the net sales here. We get the net sales. So the net sales will be 229,950 minus 1550. 228,400. So that will be our net sales. So after getting the net sales, we said we proceed and we compute the cost of sales, or basically the cost of goods sold. The cost of sales or the cost of goods sold. How do we compute this one? Quite simple. We take the opening inventory. To this we add purchases. To this we add purchases. We also add carriage inwards. Carriage inwards. We less purchases return. Purchases return, which is also known as the return outwards. And then we will be able to get something called the goods available for what? For sale. After getting the goods available for sale, remember you said we proceed and less the closing inventory. But before we do that, can we record these items? So the opening inventory, this is the first item within the trial balance. In the trial balance, the opening inventory is 50,000. We have that working in the first column. So purchases is the second item within the trial balance. Is that a figure of 170,020? 170,020? Yes, I think so. 170,020. And then to this, we add carriage inwards. In this question, do we have carriage inwards? I've not seen carriage inwards somewhere. I've not seen carriage inwards. Eunice, Marine, do we have carriage inwards? I've not seen any. I've not seen any. Yes, but we have a return outwards. Return outwards, we have it up there in the trial balance. Up there in the trial balance, the third item, which is 46. 46. And then we will be able to get now the goods available for sale. The goods available for sale. So the goods available for sale here will be what? We have 50,000 plus 170,020 minus 4,600, which will give us 215,420. 215,420. Confirm whether you're getting that. Is that what you're getting? Yes, 215,420. Then to this, what do we need to do? What do we need to do? Eunice, are you getting the same? Benson, Zuma, are you getting the same? Nicole, are you getting the same? I presume that is correct. That is correct. Okay. So then from there, what do we less? We less the closing inventory. Closing inventory is in the additional information. Additional information number 3. Additional information number 3, which is an amount of 52,000. Remember, in this case, we have said when taking any figure from the additional information, we must remember to omit the last 3 zeros. That's why you can see I'm taking that figure as 52,000, not 52 million, as 52,000. The figure which we get will be the cost of sales. We take it to the last column. So what will be our cost of sales here? Our cost of sales is 163,420. 420. Confirm whether that is what you're getting. Are you getting that figure? Is that what you're getting as the costs of sales? 163,420. So we less that from the net sales. We less that from the net sales. 228,400. And I'll get 64,980. 64,980, what is this? This is the gross profit. That is the gross profit, So after getting the gross profit, what do? To this, we add other incomes. We add other incomes. So the other incomes, in this case, include the discount received, include the decrease in provision for doubtful debts, include the rent received, the investment income, and so on. Now, when checking for incomes, also we said check the items appearing in the on the credit column, of the trial balance. That's where you get incomes. So just check the items appearing in the last column of the trial balance. So up there, you can see we have a return outwards. Basically, that is not an income. Down there, I can see we have allowance for doubtful debt, but we said what we may consider here in relation to allowance is the decrease. If, for example, this was a decrease, we consider that here as an income. But in our case, it's an increase, meaning it's an expense. Down there, I can see we have payables. Down there, I can see we have capital. And then down there, I can see a figure of 46. That figure of 46, that is a discount received. That is a discount received. And in this case, you can see the examiner here basically try to catch you by basically giving those items together. Discount received, discount allowed. You have to recall discount allowed is an expense. If it's an expense, automatically discount allowed is the one appearing in the debit column. Discount received is an income, automatically should be on the credit side of the trial balance. That's what you just need to record there. Then down there, you can see we have sales. We have considered that here. And then we have accumulated depreciation down there. In the additional information, we don't have any other income here. So what we need to do is we get the total incomes. We get the total incomes here. Total incomes. Total incomes will be what? Will be 64,980 plus 46. Plus 46, I'm getting 69. 580, 580 like that. Yes. So then after getting this, we basically move and we less the expenses. We move and we less the expenses. We less the expenses. Now recall what we said here. Recall what we said. We said when dealing with the expenses, it is always advisable you start by deducting the expenses affected by the additional information. That's what we said. So we will first of all deal with these particular expenses affected by our additional information. Later on, we take the expenses not affected by the additional information. Let's go to note number 1. Note number 1 is affecting what? Note number 1, allowance for doubtful debt. We computed this increase. This increase we said is an expense. So we say here the first expense will be the increase in allowance for doubtful debt. So the increase is 1,500. It is an expense. So then below that we have the rate. Rate is the one which is affected by note 2. And basically rate we have rate which were outstanding. So the first thing we need to do, we go back to the trial balance, we check how much were the rates which were paid in the trial balance, because the rate we have in the trial balance are the rates which were paid. Where do we have the rates? The rates are given together with the insurance. So we have rates and insurance. Okay, so the rates and insurance is an amount of how much? Is an amount of 4,000. Is an amount of 4,000. So this rate, 1, we have to add this amount of 500. These rates which were not yet paid, we add them. And also recall, we have an adjustment for insurance. Insurance is part of this. So the adjustment for insurance, I hope you can remember this prepaid insurance. We said we less that from the insurance. So to this, we less 200. We less 200. You can see those two adjustments for it. For insurance have been adjusted here because the rate and insurance are part of that. Then we get the final figure here. Final figure, which will be 4,300. 4,300. 4,300. 4,300. Is that what you're getting? Is that what you're getting, Rin? Esther, Eunice, Juma, Benson. Okay, so we are done with that. So let's move to note number 3. Note number 3 is about crossing inventory. That has nothing to do with the expenses. Note number 5. Note number 4, we said this one will not have any adjustment because these were drawings which have already been accounted for. They have already been deducted from capital. So we don't have to account for them somewhere. Or we don't have to account for them here. So number 5 is about depreciation. We have these two depreciations. These are expenses. The depreciation on buildings. Depreciation on buildings is 25. Depreciation on equipment is 500 like such. 500 like such. So we are done with the note number 5. Note number 6, we also through with it because that was affecting insurance. And I think we have already dealt with the insurance. So after doing that, what do? We go back to the trial balance, we pick the expenses which were not affected by the additional information. Sasa, yes. And basically for us to be able to do that, we have to recall that all expenses appear in the debit column. The first column is the trial balance. So let's check those items. The first item is inventory purchases. We have dealt with those. Down there, cash in hand, which is an asset. Cash bank balance is an asset. Building is an asset. And then below that, we have sundry expenses. Sundry expenses. So for the sundry expenses, that is an amount of how much? An amount of 840. So below that, we have the stationery. Stationery still is an expense. Stationery. These are the items which are used in the office, which is 1640. So below stationery, what do we have? We have the legal fee. The legal fee is still an expense. Legal fees, which is an amount of 280. And then downstairs we have receivables, an amount of 36, which is an asset. I can then see we have salaries. Have we dealt with salaries here? No. The salaries amount to how much? Amount to 39,000. 39,000. And then downstairs you can see we have selling and distribution. Selling and distribution costs. Selling and distribution costs, which amount to 1,600. And then downstairs you can see we have discount. Discount allowed is the one which appears on the debit column because that is an expense. Discount allowed, which is an amount of 6,300. Okay. So then downstairs you can see we have equipment. Then below equipment we have rate and insurance. Remember, you've already dealt with the rate and insurance here. Rate and insurance, we have already dealt with that one. Then downstairs we have return and accumulated depreciation. So we are done with all the expenses. We are done with all the expenses. Basically, what we need to do is we get the total expenses, we take them to the last column, and basically we deduct them from our total incomes. I hope there is nothing we have skipped. Have we omitted any expense? I think no. Okay, let's get to the total expenses. 15 plus 43 plus 25 plus 500 plus 840 plus 1640 plus 280 plus 39,000 plus 1600 plus 63. I'm getting 58, 460. So we need to less this from our total income here, 69,580. And I'm getting 11,120. 11,120, because that is a positive figure. That is a net profit for the year. a net profit for the year. A net profit for the year. Is that what you're getting? Net profit. Net profit. Hussein, Rin, Eunice, Esther, are you getting that? Please confirm so that we proceed. Yes, confirmed. So let's move to part B. In part B, we are required to prepare the statement of financial position of this sole trader. A statement of financial position as at 30th of April 2017. As at 30th of April 2017. Yes, so here we start by recording assets, basically which we classify into two: non-current assets and current assets. Non-current assets and current assets. So in this case, I've said let's just be using one column. I've said you can either use two columns or just one. You can't be penalized because of using two or one column. So let's just get used to using one. Because even at the higher level, once you go to financial to CP intermediate level, you'll also be able to do this topic. Financial statements, mostly of a published company, you'll be using one column, including the income statement. You'll be using one column. Yes, so let's just get used to one column. So which non-current asset do we have here? We have a number of them. Also remember assets. Assets have a debit balance. So I'm told that the profit is 111. 11. The profit is what? No, Zuma, is that correct? Is our profit this one? 1120. No, Zuma, that is not correct. Our profit is 11,120. That is our profit. That is our profit. Yes, confirmed. Okay. So let's record now the non-current asset because of time. So non-current assets, they have a debit balance in the trial balance. So which non-current asset do we have? I think first of all, I can see buildings. I can see buildings. Buildings. Can you see buildings somewhere? Up there? Yes. So what is the cost of buildings? The cost of buildings is 50,000. 50,000. To this cost, we left two items. We left accumulated depreciation at the start. Remember what you have done in the other question. I've given you a certain formula which I've said is very, very important. Accumulated depreciation at the start, which is in the trial balance, and the depreciation for the current year, which is an expense here. So the accumulated depreciation at the start is in the trial balance down there. The last item in the trial balance, 11,400. And then I will also less the depreciation for the current year, this one. So that I get the net book value at the end. That one you must understand it, because I know this is one of the area majority of the students don't get it wrong. Eunice, can you understand what you're doing here? Esther, Rin, can you understand what you're doing here? Yes. This is one of the area I know majority of the students encounter a problem. How do we compute the value of an asset at the end? You take its cost minus the accumulated depreciation at the start minus the depreciation for the current year. So which other asset do we have? I can also see we have equipment down there. Equipment, the cost is 5,000. I will less the accumulated depreciation at the start, which is 1770, and also the depreciation for the current year, which is 500. So that I get the net book value at the end. Minus 1770 minus 500. I'm getting 27, 2730. 2730. Is that what you're getting? 2730, 2730. 2730, confirmed. Okay. So I don't think we have any other non-current assets. I can't see any other non-current asset. Or do we have any other? Do we have any other non-current assets? Do we have any other non-current asset? I can't see any. So we move and record the current assets. We move and record the current assets. The current asset. So which current asset do we have? So within the trial balance, first of all, I can see inventory, purchases, cash. We have cash in hand. Cash in hand. Cash in hand is 13. And I hope that is 400. Is that 13,400? Yes, I hope so. It is 13,400. So then below that, I see bank balance. Bank balance. So for the bank balance is 32,660. 660. Then below that, I can see building, sundry, stationery, legal allowance, and then I can see trade receivables. Trade receivables. So for the trade receivables, this one will be having some adjustment. We will take the trade receivables of the receipts, and then we less the allowance for doubtful debts at the end. This one. So we don't less the increase or the decrease or the allowance for doubtful debt at the start, but we less the allowance for doubtful debt at the end. At the end, which is 5,000. That will give us 31,000. Then below that, we have salaries, selling and distribution, discount, equipment rates. Yes. Then we go to the additional information. In the additional information, number 1, we have dealt with that. Note 2, we have rate due. These are rates not yet paid is a current liability. And then note number 3, we have the closing inventory. So closing inventory, we recognize it here as an asset. 52,000. Number 4, we said no entry for that. Note number 5, we have dealt with that. Note number 6, we have prepaid insurance. Prepaid insurance, which is 200. So remember, you have said when taking any figure from the additional information, remember to omit the last 3 zeros. So then we get the total assets. The total assets. So let's add all those assets. That is 6,100 plus 2730 plus 13,400 plus 32,660 plus 31,000 plus 52 plus 200. I'm getting 168,090. 168,090. 168,090. Is that what you're getting? Yes, that is confirmed by Eunice. So then from there, what do we need to do? We proceed and record capital. So provided you remember to double arrange that, we record capital. And here we start with the capital at the start. The capital at the start of the year. The capital at the start of the year, where do we have that capital? We have capital in the middle of the trial balance there, which is a figure of 116,800. So to this number 1, we not less, rather we add this profit for the year. Net profit for the year. Net profit for the year, which is 11 120. Now, do we have drawings? Yes, we have drawings, but those drawings have already been deducted from this capital. Now, I was seeing the other option in terms of how we can account for those drawings is first of all, you add them back to this capital such that our original figure for capital will be 126,800 after adding back the amount of 10,000, which is in note number 4, and then you less them again. But no need of doing that. Is there any need? You add 10,000, you less it again, no need. So therefore, what we will do here, we will get the net capital. The net capital is basically the capital at the end, which will be 920, 120, 127, 127, 127, 127. Yes, so then from there, I want us to proceed and record liabilities. We start with the non-current liabilities. Non-current liabilities, we have said, in case of a sole trader, these can only take the form of a bank loan, And I don't think we have a bank loan in this question. We don't have a bank loan anywhere. There is nowhere we have a bank loan. So finally, we record the current liabilities. The current liabilities. So the current liabilities. In the trial balance, we have a number of them. Recall when checking for current liabilities, you check the items appearing on the credit side of the trial balance. The items appearing on the credit side of the trial balance. Which are those items? Up there, I can see a figure of 46, which is the return outward, is not a current liability. Down here, I can see a figure of 35, which is allowance. And then below that, we have trade payables. Trade payables, we have 39,670. And then below that, we have capital. I can also see we have discount received sales. And then down there, we have accumulated depreciation. In the trial balance, we only have that. But we also need to go back to the addition information. In the addition information, number 1, we have dealt with that. Note number 2, we have rates due. Rates due, these are rates which were not yet paid. Rate due or the rates outstanding at the end of the year, which basically is an amount of 500. So then below that, we have inventory, we have dealt with that. Drawings, we have dealt with that. Note 4. Number 5, we have dealt with that. Number 6, we have dealt with that. We are done. So basically what we need to do here is we get the total capital and liabilities. Total capital and liabilities. We just take this figure here, which is capital. We add these to liabilities. We should be able to get the same figure as this. You're getting? One what? 168. 168,090. So basically, which is the same with this one. Are the two figures reconciling? Are they the same? Or in other terms, is our statement of financial position balancing? Yes, it should. It is balancing. It is basically balancing. So that is it. That what is required. So by doing that, the marks allocated there were 10. So how is this question marked? So what is marked are these entries? These final figures here. These are the figures which are marked. Basically, those are the figures which should give you what? 10 marks. We should give you 10 marks. Yes. So basically, we are done with that topic. preparation of financial statements of a sole trader. It basically means that once we meet in our next class, we will be able to move to another topic, I'll be able to see which topic we will be able to cover next. But now remember, moving forward, the topics we will be covering are all about preparation of financial statements. Like we're going to look on how we prepare financial statements of a company, of a partnership, of NGOs, not-for-profit making organizations, manufacturing entities, and so on and so on. But for today, I want us to stop at that point. I don't know whether there is any question before we wind up. And I hope you have understood that topic. Have you understood what you have done as far as that topic is concerned? Have you understood that topic? Have you understood that topic? Eunice, Zuma, Benson, Esther, have you understood what you have done here? Have you understood what you have done here? Have you understood what you have done here? Yes, yes. So that is it. So maybe you can just take those particular questions which you have already done with you, and you try to attempt them again on your own without necessarily checking on what you have done here. Sasa? Yes, yes. So I want us to stop at basically at that point. We continue from there in our next class. And also we are requesting you to continue supporting us. So if you know someone who has not yet enrolled or basically gone back to college, doing this particular CASNEB courses, please refer that student to us. We will be able to appreciate. Yes. So we stop at that point for today. We continue from there in our next class as we move to a different topic. So have a good night. See you next class. transactions have taken place up to the time the financial statement are prepared at the end of the year. In this case, we said there are a number of steps which are involved. Once a transaction has taken place, we said a document to evidence that transaction will have to be raised, of which we say that that document is known as a voucher or a source document. In our case, we're able to discuss on various vouchers for the various source document which evidences the transactions which have taken place in a business. So once those particular vouchers have been raised, then we say that similar vouchers will actually be filed together, will be kept in the same file, and then next is to post those particular transactions, to record those transactions in the books of original entry, or actually in what we call as a subsidiary books. Remember, also we talked about 7 books of original entry or subsidiary books. We talked about the purchases ledger, the sales ledger, not the purchases ledger, but the sales day book, the purchases day book, the return inward day book, return outward day book, the general journal or the journal proper, the cash book, and also the petty cash book. We talked about 7 books of original entry. Now, after posting the transactions to the books of original entry, then from there we say the transactions then will be posted to something called the ledger account. So ledger account, basically, these are accounting records which are prepared to record similar transactions. For example, all transactions relating to the sales, they should be recorded in one account which is called the sales account. All transactions relating to the purchases, they should be recorded in one ledger account which is known as the purchases account. So therefore, ledger account basically are accounting records which are used to summarize similar transactions. So these basically are what? These are accounting records which summarizes similar transactions, And when recording now the transactions in this particular ledger account, we record them in accordance with a certain concept, which is known as the double entry concept. The double entry concept. And this particular concept, in other terms, we refer to it as the duality concept. So meaning that all the transactions should be recorded in the ledger account according to a concept which is known as a double entry concept or the duality concept. Now, before we discuss what is the double entry concept or what is duality concept, first of all, I want us to look on the format of a ledger account. Now, a ledger account generally has a T format. A ledger account has a T format, just like a cash book. If you can be able to recall a cash book, we say the cash book has the debit side and also the credit side. In the same case with the ledger account. The ledger account has 2 sides, the debit side and actually the credit side. So this is the debit side, and if you can be able to recall, we say debit side is, or actually the debit is abbreviated by capital D, capital R, and then this is the credit side, which is represented by what? By capital C, capital C, capital R. And then here we must have the name of the ledger account, So remember, in this case, what we have said is that this particular ledger account, they summarizes similar transactions, and always, therefore, that the name of the ledger account will be the transactions which are recorded here. If we are recording sales, if this is a ledger account which we are preparing to record sales, to record the sales of the company, then this one we refer to it as a sales account. So if you are recording, for example, certain expenses like salaries and wages, the name of the ledger account will be salary and wages account. If you are recording purchases, the name of the ledger account will be what? The purchases account. If you are recording maybe the rent, the name of that account will be the rent account. Because we have said this ledger account, they are accounting records which summarizes similar transactions. So therefore, the name of the ledger account will be the name, or the ledger account will take the name of the transactions being summarized, being recorded in that ledger account. And then generally we have, because if you can be able to recall, when we are looking on how we record the transactions in the books of original entry, we said you must record the name, sorry, the date of the transaction and the details. So the same case here, we have the date column, and then we have the details column, and then we have the amount column. This is the amount column, the amount column. The same case on the credit side, we have the date, we have the details column, and then we have the amount column. We have the amount column, the amount column like that. Now, this is basically the format of a ledger account. Now, how do we record the transactions here in the ledger account? We record the transactions in the ledger account using this concept known as the double entry concept or the duality concept. What does this particular concept state? So basically, a concept is like a principle, or in other terms, it's like a rule. So this rule of double entry, or basically the concept of the duality concept, it basically states that anytime you're recording transactions in the ledger account, anytime you're recording transactions in the ledger account, those such a transaction always affect two ledger accounts. Two ledger accounts will be affected. Two ledger accounts will be affected, and basically one of the ledger accounts will be debited, whereas the other ledger account will be credited. So anytime you're recording a transaction in the ledger account, that transaction must affect two ledger accounts. One of the ledger accounts will be debited, the other ledger account will be credited. Will be what? Credited. And therefore, anytime you come across a transaction, you're required to record it in the ledger account. Even before you proceed to record it, you need to ask yourself two questions. Two questions. One, you need to ask yourself which two ledger accounts, will be affected. Which two ledger accounts will be affected by that word transaction, and be able to show you how to identify that, how to identify the ledger account to be affected. But that is the first question you need to ask yourself. Which two ledger accounts will be affected by that transaction? And number two, you also need to ask yourself which accounts will be debited, which account will be debited, and which account or which ledger account will be credited. Because we are saying for every transaction, or each and every transaction recorded in the ledger account, it must affect at least two ledger accounts. One of the ledger accounts will be debited, whereas now the other will be credited. And actually, in this case, the amount to be credited and the amount to be debited must be the same. Must be the same. So therefore, you must be able to ask yourself those two questions. Once you're able to answer those two questions, that is the only time then you can be able to proceed and you record that transaction in what? In the ledger account. In the ledger account. Now, how do you know, for example, the account to be debited and the account to be credited? Now, there is a simple guideline which I can give you here to help you in terms of identifying the ledger account to be debited, the ledger account to be credited. Now, anytime a transaction has taken place in a business and it is to be recorded in the ledger account, it will have to affect at least one of the items within the accounting equation. It has to affect at least one item within the accounting equation. So equally, if you can be able to recall in topic number one, we talked about the accounting equation, which states that assets are equal to capital plus liabilities. So that is the accounting equation. Assets are equal to capital plus what? Liabilities. So any transaction taking place in a business will affect at least one of the ledger account here. Will affect at least one of the ledger account. And therefore, these items within the ledger, these items within the accounting equation, the assets, the liabilities, and capital can either increase or basically reduce once a transaction has taken place. So mean that a transaction can cause the value for the asset to increase, value of liability and capital to increase, or basically to do what? To reduce. Now, once the value of an asset increases, if a transaction causes the value of an asset to increase, like in this case, you are told the company bought a motor vehicle. So the motor vehicles of the company will do what? Will increase. We know a motor vehicle is an asset. So therefore, once a motor vehicle has been purchased, then that increases the value for motor vehicles. So mean that motor vehicles which are assets will increase. And therefore, what you do, you open a ledger account which is called a motor vehicle account. And you do what? You debit it because the assets are increasing. On the other hand, if the asset reduces as a result of a certain transaction, we credit the asset account. So an increase in an asset is a debit. A decrease in an asset is what? Is a credit. Is a credit. Is a credit. But now, if any of these two items increases, an increase in liability, an increase in capital is supposed to be a credit entry in the respective account, either in the liabilities account or in the capital account. So if the capital increases, credit the capital account. If the liability increases, credit the liabilities account. And then a decrease in either capital or liabilities is what? Is a debit. So if liabilities reduces, debit that account. If the capital reduces, you do what? You debit that account. You debit that what? That account. The other thing which is also important to note here is that when preparing the expenses where we record expenses, or actually when recording the expenses ledger account, when preparing the expenses ledger account like salaries account, the rent account, all these are expenses. So all expenses accounts are always debited. All expenses ledger accounts are always what? Debited. All expenses ledger accounts are always what? Debited. But on the other hand, incomes ledger accounts are what? Are credited. So whenever you're recording, you have opened a ledger account to record incomes like sales, like what else? Like maybe discount received. All those particular ledger accounts are credited. So if you can be able to record this, then recording transactions within the ledger account becomes very, very simple. Becomes very, very what? Simple. Yes. So that's basically how we are able to identify the ledger account to be debited, and basically the ledger account to be what? To be credited, and the ledger account to be credited here. So I've said anytime the value of the asset increases, we debit the asset account. Anytime the value of the asset reduces, we credit the asset account. And then we have said an increase in capital liability is supposed to be entered on the credit side of the respective account. A decrease in liabilities and capital should be debited in the respective ledger account. And then you have said all expenses are supposed to be debited, all incomes are supposed to be what? To be credited. So therefore, if you can be able to know this, then it becomes very, very simple. Because I've said, for you to be able to record the transactions within the ledger account, so you need to ask yourself those two questions here. Those two questions: which ledger accounts will be affected, and which two ledger accounts will be affected, and which ledger accounts will be debited, which ledger accounts will be credited. So if you can be able to answer those questions, then it becomes quite simple. So I want us to look on a small maybe example here. We look on a small example of how we are able to identify that two ledger accounts to be affected, and how we identify the ledger account to be debited or credited. Like in this case, let's assume that we are told a business paid rent of shillings 50,000. A business paid rent of shillings 50,000, and then in this case we are required to record these particular transactions in the ledger account. So I've said even before you proceed to open the two ledger account to be affected by this transaction, first of all, we need to ask ourselves which two ledger accounts will be affected by this transaction. So which two ledger account will be affected? So maybe in this case, I can show you how to identify that. So, okay, before we do that, let's assume a business paid rent of shillings 50,000 in cash. In cash. So in this case, you can see whatever was paid is rent. Rent is an expense. So what we do, we open a ledger account, which is called the rent account. The rent account, and actually the short form of account. I hope you can see Marimo is using something like this, 𝐎𝐍𝐋𝐶. That is the short form for the word account. Instead of writing the full name account, we put it as what? 𝐎𝐍𝐋𝐶. That is the short form for the one account. So in this case, we are saying once we have rent which has been paid, we open a ledger account which is called the rent account, which you are saying is an expense account. Then you can see this rent was paid in what? This rent was paid in cash. So in that case, we open a ledger account which is known as the cash account. Cash account. And in the cash account, we record all transactions relating to cash, money received in cash, and all expenses which were paid in cash. So therefore, in this case, you can see, number one, we have been able to identify the ledger account, the two ledger account to be affected by that transaction. To be affected by that what? A transaction. Where we have said the first ledger account to be affected is rent, and the other one is what? Is cash. Then from there, we need to ask ourselves, which account are we going to debit and which account are we going to credit? For us to be able to know that, we need to remember this. This is what will save you here. So we have said all expenses are always debited, all incomes are credited. Once an asset increases, we debit. Once liabilities and capital increases, we credit. A decrease in assets is supposed to be credited, and basically a decrease in liabilities and capital is supposed to be debited in the respective account. So here, one, rent is an expense. So being an expense, recall what we have said here. We have said all expenses are supposed to be debited. So this account automatically will be debited. And once you're able to identify the account to be debited, it is obvious that the other account will have to be credited. So this account will be credited, but why is it credited? So we know cash. So who can tell us here? What is cash in a business? If you have cash, what is that? Is cash an asset? Is it a liability? Is it capital? Who can tell us here? What is cash? If you have some cash, what is that in your business? Asset, liability, or capital? What is that? Yes, automatically this is cash. This is an asset. So being an asset, and basically you have taken some 50,000, you have paid rent. What happens to your cash balance? Maybe you had a cash of 100,000. Out of that 100,000, you have taken 50,000. You have paid rent. What happened to your cash balance? Does it increase? Does it reduce? I'm told it will reduce. Yes, automatically in this case, the cash balance reduces. So if the cash reduces and basically is an asset, if cash reduces and it's an asset, what do? We credit. We do what? We credit. So therefore, this account will be credited. Will be what? Credited. So having that now, what you do, you proceed, and basically you open the respective ledger account. You open the ledger account. You open the ledger account here, and assuming this transaction took place on 1st of May, 2025. So in this case, we will open two ledger accounts. The first ledger account you're going to open here will be known as the rent account. The rent account like that. Now, remember I've said that these ledger accounts, they have the debit and the credit side. And actually, I've said each side has 3 columns, the date, details, and the amount. But practically, whenever you're preparing these ledger accounts, we prepare them using a T format. But it's upon you not to recall, you must always start by recording the date, details, and the amount. So you don't have, it's not a must you have all those columns. We just have the ledger account using or in that format of a T. So and then this is the rent account. The other account we need to open is what? Is the cash account. You must also be able to note here that this is the debit side. Denote that with DR, and this is the credit side. That is the credit side. Then you are saying this transaction, which